Welcome to The Deep Dive. We're the show that really tries to cut through all that earnings call noise and give you the core insights. Today, we're digging into the recent first quarter results for fiscal year 2025-2026 from Sify Technologies. You might also know them as Sify Technologies. Our mission, really, for this deep dive is to try and unravel what seems like a bit of a paradox. You've got this company with pretty impressive revenue growth, a really ambitious vision for India's digital future, but they also reported some significant losses. So we want to distill what the leadership team wants you, our listener, to know. Look at the strategic shifts they're making and, explore what it all actually means for the bigger picture.
That's right. And this call, it offers a really crucial glimpse into how they're positioning themselves, right at the heart of India's, accelerating digital transformation. It's not just about the numbers, though. It's really about understanding the conscious strategic choices they're making, particularly across their different business segments and what those choices mean for their long-term vision for growth.
Okay, so let's unpack those headline numbers for Q1 then. Sify Technologies reported revenue of INR 10,723 million. Now that's a solid 14% increase compared to the same quarter last year. So good start.
Decent growth there, yeah.
And their EBITDA, a key measure of operational profitability, that also saw healthy growth. It was up 18% year over year to INR 2,111 million.
Okay.
So good growth, pretty good operational performance on that front. But here's where it gets interesting. The company reported a loss before tax of INR 322 million and then a loss after tax of INR 388 million. That's after accounting for tax on profits from one of their data center subsidiaries.
Right, so the bottom line looks quite different.
Exactly. And their capital expenditure for the quarter, their CapEx was pretty substantial too at INR 2,874 million.
Yeah, and what's truly fascinating here isn't just the numbers themselves, but how management frames this apparent contradiction.
Yeah.
They explicitly stated that while these results, they reflect the impact of depreciation from all those big asset investments and higher interest costs, plus increased manpower expenses, these aren't accidental. They actually describe them as conscious trade-offs.
Conscious trade-offs.
Yeah, it's a deliberate strategy, they say, to build future-ready capabilities across their businesses with an eye firmly on long-term value creation, not just, immediate quarterly profits.
Conscious trade-offs is, it's a powerful phrase. But for you listening, it kind of begs the question, doesn't it? How often do these big strategic bets really pay off? And maybe more importantly, what specific indicators should we be looking for? To validate if Sify Tech is actually on the right track here, rather than maybe just burning through cash.
That's an excellent point. It is a common strategy, especially for growth companies, particularly in these infrastructure-heavy sectors like data centers and networks. To see if it's paying off, you really need to look closely at the segment performance and understand the underlying rationale for each specific investment. Management sounds confident, which suggests they believe these are foundational investments that will eventually deliver, disproportionate returns down the line.
Okay, so let's dissect where that revenue actually came from, because that should tell us a lot more about the company's strategic focus and maybe help explain those consolidated losses. So the revenue split for the quarter: network services contributing 41%, data center colocation services 37%, and digital IT services 22%. So what does this mix tell us, especially when we think about those losses?
Well, this immediately flags up an important point about their sort of diversified business model. Each of these three segments, they have really distinct capital deployment characteristics, how much money they need, and vastly different EBITDA margins. And that difference significantly impacts the consolidated profitability you mentioned.
Right.
The data center business, that's their high margin performer, it boasts a pretty impressive EBITDA margin, close to 45%.
Wow, okay.
Network services, which is actually their largest revenue contributor right now, operates at around an 18% EBITDA margin. Still healthy, but quite different.
Mm-hmm.
Then you've got the digital IT services business. And this is the one management described as very much work in progress. And that's the segment that largely explains the current consolidated losses. The CFO did emphasize, though, a steadfast commitment to cost efficiency and fiscal discipline, but always with that long-term value creation goal in mind.
It's interesting, network services being their largest segment by revenue, yet we hear so much more buzz around data centers and AI lately. So what's the strategic importance of network services in their portfolio? Is it just a stable revenue stream, or is there more to it?
Oh, it's absolutely crucial. I mean, while the data centers are definitely the high growth, high margin story everyone's watching, network services provides the backbone and, importantly, a steady cash flow. Think of it like the foundational layer for all this digital transformation in India they talk about. It ensures the connectivity. It enables the very digital adoption that drives demand for their other services like data centers and IT. It's a more mature business, sure, but it's critical for market reach, customer relationships. It often provides that stable base that lets them actually take those bigger bets in the other segments. So yeah, it's not just a revenue stream. It's really an enabler for the whole ecosystem they're trying to build.
Right, that makes sense. Okay, speaking of those bigger bets, the data centers. They are clearly pushing forward with significant expansion there. They commissioned 8.66 megawatts of additional data center capacity just this quarter.
Except in Q1, yeah.
Which brings their total operational capacity available for sale up to 138 megawatts as of December 2024. They also confirmed that 2 large greenfield projects, brand new builds in Delhi and Chennai, each designed for 26 megawatts, have gone live in the last 4 months.
So that capacity is coming online now.
Exactly. And get this, there are even more in the pipeline. 2 facilities in Mumbai are under construction. That's another 52 megawatts combined design capacity, expected to go live later this financial year, plus another greenfield project after that. It's a massive investment.
And here's where it gets really interesting on the data center front. This is what could potentially position them uniquely. They introduced something they're calling a pay-per-use colocation AI model.
Pay-per-use, how does that work?
Well, it's quite innovative, actually. First off, their facilities in Mumbai, Chennai, and Noida are all certified by Nvidia for liquid cooling. That means they can support really intense workloads, up to 130 kilowatts per rack, which is huge for AI.
Okay, so high density is key.
Precisely. Now, their unique offering allows clients to bring their own GPUs, those powerful AI processing units, and host them in Sify Tech's facilities. But here's the kicker. It's on a flexible per-use basis, per hour, per demand, monthly or yearly, whatever fits the client's needs.
So they're essentially offering like a GPU hotel, but with extreme flexibility. How does that truly differentiate them, though? I mean, the market has some global giants in it. Is this just a niche play, or could it genuinely set a new standard?
Exactly. A GPU hotel is a good way to put it. It's a very clever move, I think. Traditionally, colocation is, long-term contracts, fixed space, fixed power. This pay-per-use idea aims to complement existing GPU pricing models. It lets clients match their colocation costs directly to their actual GPU usage. Think about AI development. Yeah. It often involves these burst workloads, right? Or projects with uncertain timelines. This model makes high-performance computing more accessible, lowers the upfront capital expenditure barrier for clients.
So lowering the barrier to entry for AI compute.
Exactly. And while it's literally just started, they don't have concrete numbers to share, yet they are already seeing significant global interest, they said. So this positions them directly in that burgeoning AI infrastructure space, not just as another data center provider, but as a flexible enabler of AI innovation.
Could it carve out a significant niche? I think so, yeah. Especially for, say, startups or companies with fluctuating AI compute needs, it could potentially disrupt those traditional fixed lease models. Definitely one to watch. Okay, let's pivot now to the digital IT services segment. The top line here, as we noted, was flat year over year, and operational losses actually increased. This definitely stands out, especially given the overall growth narrative we've been discussing. What's going on there?
Right. This segment is a really key area of strategic transformation, and that's why it's reported as work in progress. The flat top line, apparently, is a direct result of a conscious decision they made to change their business model. See, previously, this segment was heavily project-based, episodic, one-off contracts.
Right, like building a custom solution each time.
Exactly. Now, they're deliberately shifting towards annuity or recurring services. Think of it like moving from building that custom house for each client to selling subscriptions for a standard software service or managed services. Now, recurring revenues, they usually start smaller, right? But they provide that long-term predictability and, crucially, significantly higher margins over time once they scale up.
Okay, so jam today versus jam tomorrow, essentially.
Sort of, yeah. And the losses, as management explained it, are a function of continued significant upfront investment. They're investing in people, acquiring new talent, building out the new capabilities needed for this recurring revenue model. They apparently started this whole journey about 3 years ago, and they sound very confident about the Indian enterprise IT services market opportunity. They expect to start seeing those losses shrinking and the operating performance improving within the next 12 to 18 months.
12 to 18 months. That sounds, well, pretty aggressive for a turnaround, especially with losses increasing this quarter. What are the key milestones, do you think, or maybe potential roadblocks they face in actually achieving that profitability pivot in IT services?
Yeah, it is aggressive. The biggest milestone, I think, will be demonstrating a clear acceleration in signing those recurring revenue contracts. They absolutely need to show that new client acquisitions and maybe the conversion of existing clients to this annuity model are really starting to outpace the costs of building out those new capabilities. Roadblocks. Well, slower than anticipated market adoption of their new service offerings could be one. Intense competition. I mean, the Indian IT services landscape is fierce, or maybe difficulty in hiring and retaining the top talent they need for this kind of transformation. The next few quarters, yeah, they'll be pretty critical in showing real progress on shifting that revenue mix.
Okay. Now, the chairman, Mr. Rajivina, he opened the call with a very expansive vision for India's role in the global digital economy. He painted this picture of a nation not just, participating, but actually leading. What was the main takeaway from his remarks? How does that connect back to CV Technologies' strategy?
Yeah, his opening remarks are quite striking. If we connect this to the bigger picture, the chairman firmly believes, and he said this quite directly, that the next decade of digital infrastructure will be written in India. Written in India, strong words. Very. He highlighted what he sees as an unmatched pace of investment in technology, cloud adoption, automation by both public and private enterprises across the country. And he framed it not just as organic growth, but driven by a real, palpable urgency. An urgency not just to participate, but to actually lead the global digital economy. He specifically cited national programs like Digital India and the newer India AI mission, which are bringing, significant government investment into compute infrastructure and digital access for everyone.
Okay, so government initiatives are a big factor.
A huge factor. And crucially, he stressed that India isn't just going to be consuming AI developed elsewhere. He sees India rapidly moving up the value chain to become a creator of high-quality AI tools, frameworks, and domain-specific solutions. This ambition, he argued, will translate directly into robust demand for the kind of integrated infrastructure they provide, supporting high-performance workloads, edge computing, sovereign data requirements, all of it. His core message was clear. India won't just be a growth market, it will be the growth engine. And that whole vision, that provides the essential macro backdrop for their significant capex, for their strategic investments. It frames their aggressive data center expansion and that pivot in digital IT services as being directly aligned with this, national transformative wave.
Okay, a powerful vision. So let's bring it back down to earth. What does all this mean for you, the listener, maybe thinking about this as an investor? We're seeing heavy investment, yes, some current losses, definitely, but also this very strong, almost visionary long-term outlook. What should people be considering here as they evaluate CV Technologies?
Well, it absolutely raises that important question about the long game versus short-term performance, doesn't it?
Mm-hmm.
The company is clearly, undeniably, in an investment phase, particularly in that digital IT services segment, and that is directly impacting their consolidated profitability right now. We saw the group level EBITDA margin is currently around 19-20%.
Right.
Management acknowledged they have aspirational goals for higher margins. They mentioned aiming for around the 25% region eventually. And that would be driven primarily by operating leverage in their high margin data centers and the stable network services, but critically, only once that IT services business gains real traction and actually becomes profitable.
So a lot hinges on turning IT services around.
A lot does, yes. They are actively working towards gradual improvements, they said. Maybe adding 100 basis points, that's 1 full percentage point to their overall margins over several quarters. So slow and steady improvement is the goal there. Now, the chairman's vision of India as this digital growth engine, that provides a powerful, almost unparalleled tailwind, you could argue. However, for CV Technologies to truly capitalize on that tailwind, they absolutely must execute. Execute precisely on these strategic shifts we've discussed, especially leveraging those unique data center capabilities for AI workloads and successfully transforming digital IT services to recurring revenue. That's key. And while they didn't give specific full-year growth guidance, double-digit growth remains, they put it, a clear wish list for the management.
A wish list. Okay. Well, as always, just a reminder, this analysis is purely for informational purposes. We are definitely not offering financial advice. And you should always conduct your own due diligence before making any investment decisions. But just for the sake of exploring plausible scenarios, maybe let's entertain a wild yet plausible trade idea that kind of builds on what we've heard today.
Okay, let's speculate a little, but within reason.
Mm-hmm.
Given CV Technologies' strategic positioning, right? particularly with that Nvidia-certified liquid-cooled pay-per-use data center model for GPUs. And coupling that with the chairman's big emphasis on India becoming an AI creator, not just a consumer, a compelling, though, yeah, definitely speculative trade idea could be a straightforward long position on Sify Technologies, or Sify Technologies as it's also known.
Okay, so long position. What's the outrageous but plausible angle?
The outrageous but plausible angle, I think, comes from the idea that the broader market might be underappreciating the long-term, high-margin potential of their unique AI colocation offering. Perhaps the market is currently viewing those losses of digital IT as more of a drag than a strategic, necessary investment for future growth. So the trade would essentially be a calculated wager, a bet that the future-ready capabilities they keep talking about building, especially those AI-focused data centers, will eventually deliver disproportionate returns as India's AI ambitions really materialize. Returns that could significantly outweigh the short to medium-term headwinds from that digital IT services transition. You'd probably want to consider a multi-year investment horizon for this kind of idea, reflecting that 12 to 18-month timeline they mentioned for the digital IT segment turnaround, plus the longer-term AI growth story unfolding in India.
Interesting. A bet on AI infrastructure and execution, essentially. Okay, we've covered a lot of ground in this deep dive into Sify Technologies' first quarter results, from the strong revenue growth in their core network and data center businesses to that really key strategic pivot in digital IT services towards annuity revenues. And underpinning it all, that ambitious vision for India as a global digital and AI powerhouse. It seems pretty clear that while the company is reporting losses now, these are being presented very deliberately as investments into future capabilities.
Exactly. It's a company making significant conscious investments, as they said, for those future capabilities. And they're aligning themselves squarely with major macro trends and what is arguably one of the world's fastest growing digital economies. But as always, remember, all investment carries risk. And this discussion really is just for educational purposes.
Absolutely. We hope this deep dive gave you, our listener, a clearer, maybe more insightful picture of the company's direction and the underlying story behind those Q1 numbers. What stood out to you from this deep dive? We always love hearing your thoughts. Thank you for joining us on the deep dive.